Hello, advisory letter subscribers. This is a position of ours, and I'm just going to give you a lesson on the setup, the management, the constant legging in of covered calls and the rationale, and then show you the tremendous extra return on capital that we have generated by this master trader legging into covered calls strategy. So this is Tandem, TNDM. We initiated or recommended just 25% position on this particular day, on the 8th, and it was because, we only did a partial position because we don't buy breakouts that are multiple bars to breaking out. However, we wanted a position, and we were going to add over time. This is the daily on the left, weekly in the middle, monthly on the right. We entered this as a core position trade because of the bullish weekly and monthly had a big price range. This is a buy setup on the monthly chart, bottoming tails, rising 10-period moving average, and our first target is 60 bucks. Let me spread this out for you. Look, this has a long way to go. So we wanted to give it room, but we leg into covered calls when momentum slows to reduce our cost basis over time to generate additional returns. We've now done it. We did it once here, lowered our cost basis. We did it again here, lowered our cost basis. And now the question is, because today's Friday option expiration day, we currently have a covered call. Long stock, short the $46 calls. When we do that, we're putting money in our pocket, which reduces our cost basis, giving somebody the right to buy our merchandise at the strike price, 46 bucks, on or before expiration, which is today at 4 o'clock, or really 4:30 Eastern. So here's the question that we have to analyze. Did the chart turn more bullish with today's breakout of last week's high, where we don't want to sell a call option because we don't want to cap our gains? Or do we want to keep doing it because the math makes sense because we're still making a whole lot more money? And that's the way we trade. We aren't pigs. We like to constantly have high probability setups, lower our cost basis through diagonals or covered calls or legging into bull call credit spreads, etc. So the premiums are so juicy. So we're going to roll today's $46 call, which is only a nickel or a dime right now, to next Friday's $47 call for 85 cents. So that's going to further reduce our cost basis all the way down to $37.80. We bought this right at 40 bucks. So we've made $2.20. If you divide that by the $40 original cost basis, then we have just generated an additional 5.5% return in 1 month. As of next Friday's expiration. If you annualize that, just simply multiply it times 12. And it's staggering, but we still own the stock at $37.80. We're going to now move the stop to under this bottoming tail, because then if it fails, then I got a breakout failure, and then I'll be done with it. So that's what we're recommending right now. It's a beautiful trade-off of earning these fantastic returns. And worst case scenario, well, it's not the worst case. The worst case is if it, gaps down $40 on us. But let me say it this way. With this extra roll, agreeing to let somebody buy our merchandise at $47, if it gets taken away from us next week, let me do the math on this real quick. So 47 bucks less 37.80 is $789.20 divided by the cost basis of 37.80. That would be 24.3% return in 1 month. So we can then just make a decision next week. take my merchandise at 47 bucks and I'm off to the next bus ride, or we can roll it again. And we have not lost money by definition. Even if the stock's at 47.50, we buy the call back and we'll roll it out to the next one. So again, I think that we're done. That's the technical reason for entering the trade. I'm showing you how we're managing it on multiple time frames, and this is just a Friday expiration recommended adjustment. Good trading, everyone.